Let's bring in our headliner, as we always do. He's Jeffrey Gundlach. He's the CEO, the CIO, and founder of DoubleLine. He joins us from Los Angeles, as always. Welcome back. It's good to have you.
Good to be with you again, Scott. It's been a while with Chair Powell. It's been a long ride. I think this is our 43rd time talking about the post-presser situation. I think the words of the meeting, certainly legal battle, was something we haven't heard before. And he wanted to take a parting shot on that, it seems. But also, it's a little bit hawkish on inflation misbehaving. And he said, if you blinked, you missed it. But he basically said, if the tariff effect doesn't fade in the next quarter or two, and if oil prices, remain challenging, we won't even think of reducing interest rates. So it's not surprising that we saw rates back up, the yield curve flatten in a bearish fashion, with two-year Treasury yields going up about 10 basis points after that meeting. And now the two-year Treasury yield is above the high end of the Fed funds rate. It's almost at 4% now. I suspect it will go to 4%. And it looks like the 30-year Treasury is settling in, moving up to about 5%. So the bond market has started to price in higher inflation, lasting longer, and we think that's absolutely appropriate. We think that based upon the commodity complex right now, that the year 2026 will end up in the high threes for the headline CPI. And we might even see, based upon where oil is right now, and that will affect inflation for the next couple of months, we might see a 4 handle on the CPI. And that's in a month or two. And that's clearly suggests that the Fed cannot be cutting interest rates.
Right.
So it's been an interesting period in the bond market. Treasury market's been so stable. Yields haven't really changed in a year at many parts of the yield curve. And year to date, virtually every bond sector that's a traditional sector, like high yield, bank loans, investment grade, mortgage-related securities, treasuries, they're all negative on a total return basis, particularly with the down prices today. And so the only thing that's actually up in the bond market is local currency emerging market debt, which has a small positive rate of return in the context of other bond sectors being, in worst performers, bank loans down about 2.2% on the bank loan ETF, and everything else is down about 0.5% or so. And it's been very, very stable. I don't take the stability in the interest rates as likely to endure for the remainder of 2026. It's just been stable for such a long period of time. Last year, we were marveling at the fact that the WTI curve was predicting no change in the oil price. Going forward a year, the oil price was projected by the WTI curve to be $56 plus or minus $1 for months on end. And then all of a sudden, that stability got completely shattered, obviously, by the war situation. And so now oil is up tremendously. So the number one performing asset class, if a traditional asset class really, is the Bloomberg Commodity Index, which has had a tremendous run this year. It's up a tremendous amount. Mm-hmm. But I think investors should hold on to commodities at this point in time. I'm not really that fond of gold in the near term. It peaked out at about 5,500. And after the vertical rise up from 3,500, I wouldn't be surprised if gold went down below 4,000 before resuming its rise higher. So wow. I had been recommending that investors own a commodity index, like the Bloomberg Commodity Index type of thing, and also a little dollop of gold directly in there. With the XAU or whatever it is, and you could have an overweight to gold. I don't recommend that right now. I think there's going to be a cheaper entry point. But commodities broadly certainly seem strong. Obviously, that's been powered by the energy sector
Sure.
since the war started.
Yeah, you would, as you would expect. So on both of those notes, Jeffrey, the dissents, to which David Kelly earlier, and I know you respect his views and you cite him often in our conversations, called those the Fed's declaration of independence as they look ahead to a new chair and, in a sense, holding the line, saying we're not going to be moved by any political winds or anything else that are blowing in the direction of wanting us to do one thing or the other. So what was your take on that before we get to Powell's decision to stay?
Yeah, I mean, I think they cleared the decks, really. You know, they've been having this easing bias, and I guess they still have that in the statement. But based on the press conference and those 3 dissents, it's pretty clear that they want to be truly sort of viewed to be neutral in terms of a bias. They say there's an easing bias, but it didn't feel that way in the press conference. I felt like there's more of a tightening bias at this point, and that's married as well to the 2-year Treasury heading towards 4%. I mean, that's suggesting that there should be a hike sometime between now and the end of the year. I remember in our earlier visits here in the first 2 Powell press conferences, I pointed out back in January, I didn't think there'd be a rate cut this year. And now and then last time we met, I said, if all you got for wanting risk assets is that you're banking on 2 rate cuts this year, you're backing the wrong horse. And that has certainly turned out to be the case. I mean, the warp function that looks at the shape of the yield curve suggests that there's just no rate cut this year. And I wouldn't be surprised if it started skewing towards a rate hike if the inflation numbers start. If we get a 4 handle on the CPI, I think there's going to be a lot of people talking about inflation is not close to 2%. I mean, inflation on the core CPI actually tracked for a couple of decades right along the 2% line. And then after COVID, we had 2 or 3 years of, on average, 5% inflation. And in the years since 2023, it's averaging 3% inflation, and we're going to go into the mid-3s at a minimum as we move forward in 2026 based upon this energy shock. And so I just don't think that there's a case for an ease between now and the end of this year, unless something bad happens.
Do you actually think there could be a hike?
Some sort of a shock.
Forgive me for interrupting you, but
I think
do you actually believe there could be a hike?
I think the odds of a hike between now and year end are better than the odds of a cut. And I think that's going to come further into focus as we move forward. This oil situation is just going to last longer than people are hoping for. Brent is up at $120. A lot of the actual transactions that are not in the futures markets are at higher levels than that. And there's a real problem here. And so we know that the food prices are very likely to go up once again because fertilizer prices are way up. And of course, the cost of transporting the food items is going to go up substantially. It's already gone up, and it's going to be sticky based upon this enduring war. You know, they always say the boys will be home by Christmas when we go into a war, and it never seems to be the case. So I just remember the Ukraine war. The idea was that Russia was just going to roll over them in 2 or 3 weeks, and that would be the end of it. Here we are years later, and we're still involved there. People have forgotten about that. The other issue that is on my list of worries is we've blown up a lot of our weapons stockpiles. You know, like the Tomahawks, we've fired a third of the stockpiles. Some of the other missiles, we've blown up half of them, and it takes a while to recreate this stuff. I saw a comment that someone from the administration or a government official anyway was saying that if China wanted to get aggressive on Taiwan, it's not clear that we would be in a position to mount a defense if we so decided to do, because our weapon stockpile is so drawn down. So I think that, unfortunately, I think this oil spike is going to be with us for quite some time. So and that means that the inflation forecasts have to go up.
So if they do, I mean, what does that mean for Kevin Warsh? And what kind of Fed chair do you think he'll be?
I think he's been clear on one thing for sure, and that is he doesn't like forecasting the future or giving hints of what the Fed's going to do. He doesn't seem to like the dot plots. I don't like the dot plots myself. I think it's almost embarrassing that every time they do a dot plot, they say in 2 years, last time it was 3 years because they had to back off the 2 years, but always used to be in 2 years, inflation will be at 2% per the dot plot. Now, this time it was in 3 years. But I think that he's going to not want a lot of, I think he might cut back on the press conferences. That really wouldn't bother me that much. I kind of think every 6 weeks, I kind of like it when the press conferences, when they skip a meeting, you know, like in the summertime. So you actually have a little bit longer period between the meetings, so you get more information. I think there's a little bit too much information that comes from the Fed, frankly. Too many opinions, I think he's going to want to be more of a primary spokesperson and discourage other Fed governors from speaking their mind on something of a regular basis. And I kind of favor that. I think nobody knows the future. Nobody knows what's going to happen 2-3 years from now on the inflation rate and the unemployment rate. You just have to work in real time. And he's spoken that way, and I respect him for that. I mean, I liked Jay Powell. I didn't think it was the best Fed chairman ever. I thought he was too late. He was certainly too late on hiking rates in 2021. I remember when they finally went to the 25 basis points, I said, Painter, get off the ladder. Let's do 200 basis points right now. And then in 2024, they were way, way behind the Treasury bond market. There was 175 basis point spread between the Fed funds rate. The 2-year Treasury rate was 175 basis points below. And amazingly, after all these rate cuts, 175 basis points of rate cuts, the yield curve is up since the first rate cut by the Fed. Since the day of the first rate cut by the Fed, the 2-year, 5-year, 10-year, 30-year, they're all higher. And in fact, the 30-year Treasury rate has never been lower since they started cutting interest rates. It's been higher the whole time, most of the time by about 100 basis points. And I've been talking about how I don't really like the long-term Treasuries. I'm a little less strident in that opinion right now. In fact, today, after the announcement and after the bond market sold off, we actually bought some Treasuries, intermediate-term Treasuries. I didn't buy 30-year Treasuries, but we bought some Treasuries in the sort of the middle part of the yield curve, thinking that even though inflation's going higher, we've got rates now that even if inflation goes to 4%, you buy the 5-year Treasury, you're actually getting higher than 4%. And you roll down the yield curve on that, so you might get a little bit of a gain just by the passage of time. So I do think the chances of a rate hike, because of the inflation problem, which Jay Powell used the word misbehaving, I think the probability of a hike is greater than that of a cut.
Wow. I like the real-time trading activity, too, that you're bringing to our viewers as well, as you're sort of taking in everything that they are in real time. You mentioned, let's call them the Powell misses. Too late, the transitory mistake, obviously, is well documented. But what about the hits, so to speak, and the things that he got right, and how that will influence, in your mind, how he should be judged in the totality of his reign as Fed chair? The worst, health crisis in 100 years. The worst inflation to deal with in 40. The tariffs, the supply shocks, which he himself today said we've dealt with for the last 6 years, and navigating all of that, and how he should be judged in total.
I think when it comes to the economy, the stability of the economy, he's right to take some credit for that. That's a success. That with all that you referenced, you really didn't have a recession. Now, of course, the money from the government caused the inflation, and I think he could have fought back a little bit more on that. But the fact that there was no, other than the couple of months there when the economy hit the elevator shaft down, I mean, I think it's to his credit that the economy has been very stable, and the unemployment rate has not really gone up, in spite of the fact that there's been a lot of dynamic shifts in the labor force and the immigration going to emigration, forced emigration. I think the fact that the unemployment rate still has not accelerated above its 3-year moving average is to his credit for having. He's balanced the mandates pretty well against very challenging conditions along the way. So I give him credit for the fact that the economy has been robust, frankly, more robust than virtually everybody, including myself, thought that it had any right to be, given all of the challenges.
What do you make of his decision to stay on? And again, this sort of defiance that really sort of he exuded today when talking about what he sees as an assault on Fed independence, which he called at risk.
Yeah, well, he held his tongue for many of these press conferences when people wanted to dig into the tension here. And he always said, I'm not going there, I don't have anything for you there. And he just I think he just felt that he had, this was an opportunity to directly speak. I mean, when the first question came out, I think it was Steve Leisman's question, I think he went into reading a written statement about the legal attacks and how we got to get back to norms and all this sort of stuff, which is typical of mainstream politicians. They always want to talk about norms because norms mean that they stay in power. But I thought that I thought that Jay Powell was. I liked the way he handles him. I liked the way he handled himself. I think it's fair enough that he said he spoke his mind on. He doesn't think that this is a path to be going down, and particularly with the regional governors and stuff like that. I agree with him on that. He says it would be the beginning of the end if we started removing, for political reasons, Fed officials and governors. And I really agree with him on that. I mean, that I would just have the Fed funds rate set at the 2-year Treasury, and that's kind of where we are. It's a little bit higher now, but I like the fact that he kind of pushed back a little bit. I give him credit for that.
Do you at all worry about what the likes of Ray Dalio has been talking about of late? I know you care deeply about the deficit and the long-term ramifications of that, but Dalio earlier this week said of the economy, as resilient as it still may be, and Chair Powell sort of doubled down on his belief that it is, said that stagflation is already here, that we're in that era, that it's already arrived, which means that Kevin Warsh's Fed chair is going to have a potentially more difficult road ahead if we truly are in a stagflationary environment, one in which the Fed, with all respect to the toolbox, is sort of limited in its fight.
Yeah, I've been talking about the debt and the deficit for a long time, and here we are again with it on the course for fiscal 2025, I guess it is, to have a $2 trillion budget deficit plus again. And this is one of the reasons why I've been negative on long-term bonds. I just feel like there's just too much uncertainty about what ultimately is going to be the solution or the attempted solution at all of this stuff. The deflation part, I think, is there, obviously, with our forecast for the CPI to go over 4% on the headline number. That's a pretty big inflation rate when your goal is 2. So, but the stag, I don't know. The economy's a little bit weaker. Jay Powell mentioned that. But I don't feel like the economy is anemic at this point in time. You've got manufacturing doing pretty well. Business investment might start to weaken with some data that's coming out, some news items on data center buildings and some vacancies and stuff like that. But I just feel like the consumer still seems to be in fairly good shape, and interest rates just still aren't all that high. Mm-hmm. So I think we have more of an inflation problem than an anemic growth problem at this point in time. And that's what the Fed needs to be focused on, and that's why I'm leaning towards a hike and not a cut.
So I'd like to end by asking you about a topic that we've spoken about numerous times, speaking of warnings from smart investors, and that is private credit, a topic which you'll be speaking about, from what I understand, next week out at Milken. So a large room of thousands of people are going to hear what you've been telling us and our viewers for many months, your concerns. Are they as are you as concerned today as you have been? I mean, look, the economy is hanging in there. There were some pretty big negative bets being made on what software companies may do or may be unable to do, but probably better said, in the future. But where do you come down today on that, and what will you tell that room full of investors?
Well, I'm on a panel, which I usually don't do, but for Milken, you're kind of stuck that way. And I'm on a panel with 4 people that are all going to be very positive on private credit. So it's going to be 4 against 1. So I like my chances. I like my chances there. But I think private credit is a slow-moving problem, and the problem is not so much the defaults, although there's growing news of defaults. It's basically the trust factor. The trust factor has kind of faded away. I think investors didn't really well understand the liquidity limitations of these interval funds. And it's pretty clear that the marks are a little bit iffy on these things when you get news bombs, tape bombs of some sponsor marking down a position, 50 points or 100 points. This is not going to stop. There's a trust factor here that's a problem, because I think there's an essential mismatch between. I'm not that negative on private credit. I'm negative on these interval funds that are trying to do the unnatural. They're taking illiquid assets that everybody knows are long-dated illiquid assets, and they're offering liquidity on them. And that's not going to work. And so I'm more worried about just the exodus of money. People say, well, there's nothing wrong with these assets in private credit. It's just a liquidity problem. Well, that's what took down Silicon Valley Bank. They owned treasuries and Ginnie Maes. They didn't have any default problem. It was just a mismatch of assets and liabilities. And that's what private credit with interval funds has set itself up for. So I tweeted out several weeks ago, beware the Ides of June. And that's a pretty cryptic tweet, or X, or whatever you want to call it. But what I mean is June 23rd is the Ides of June. It has something to do with the moon phase. It's not always the 15th of the month. And I think you're going to get humongous withdrawal requests from these interval funds in June. And I think that's going to be a catalyst for more angst in the interval fund universe.
All right. Well, I'm sure you'll make headlines out in Beverly Hills. We'll follow that, and you always make them with us, so we're appreciative of you being with us every Fed day. Next time, we'll just do it with a new chair. Jeffrey, thank you.
We will. Thanks, Judge. Good to be with you.
All right. Yep, you be well. That's Jeffrey Gundlach.